Weak numbers on the US labour market, well, they've led to widespread fears that the US is heading into recession, and although this certainly wasn't the only reason, it's been followed by a slump in equity markets around the world, especially in Japan. Bond markets have rallied hard. In this week's Market Perspectives, I'm going to take a look at the recession risks in the US and attempt to draw conclusions for the outlook for financial markets. Now, the key element in last week's US data that led to the heightened recession fears was that they triggered something called the SARM rule, named after an economist at the US Federal Reserve. She's now working at Bloomberg. And she noted that whenever there was a rise of 0.5 percentage point in the 3-month moving average of the US unemployment rate compared with its low over the previous 12 months, that signalled a US recession. And this rule has given no false positives and no false negatives since 1950, when there have been 11 US recessions. It's also accurate in terms of timing of a US recession within a few months, much more accurate than standard measures like the yield curve. It is, therefore, something to be concerned about, something to be investigated. Now, the first point to note is that the timing of US recessions, unlike in other countries, that's determined by a committee of economists at the National Bureau of Economic Research. And they look for a widespread downturn across the economy that lasts for more than a few months. Now, we are clearly not there yet. Taking a step back, there is very little evidence of the sort of financial imbalances that typically presage a recession. Both personal and consumer balance sheets are in good shape. There is not the widespread downturn in the economic data. I do expect a slowdown in the US as the consumer there retrenches, but that would be a modest pullback, not a recession. There are also concerns about the numbers for unemployment themselves, which have triggered this rule. Much of the rise in last week's data reflected a huge jump in those out of work due to bad weather or temporary layoffs, and that should quickly reverse. In addition, there has been a massive influx of unauthorized immigrants to the United States. Now, they're typically eligible to work after a few months, but they have higher unemployment rates in the first 12 months of their arrival. That's also a factor. In addition, the survey that generated the data, the household survey, that's seen a significant decline in response rates, and that makes the numbers much less accurate. We've had a similar decline, but on a much bigger scale here in the UK, and that's led our stats agency to basically ditch the survey. And finally, the inventor of the rule, Claudia Sahm herself, well, she says this doesn't mean the recession is upon us. Now, I am reluctant to say, it's different this time, when a rule has worked so well in the past, and the data might take a broader and deeper step down in the US. But my best guess is that this is a false alarm. So what does all this mean? First, the big market moves, they're not all due to the weak US data. We've had the unwinding of a huge carry trade and other trades, and that explains why the biggest moves have actually been in Japanese equities and similar markets. And such position unwinding moves tend to have an exaggerated market effect when they occur in August. If I'm right and the US slowdown does not turn into recession, we can expect equity markets to stabilise and recover. There may also be a more enduring effect on the Federal Reserve. They've come in for a lot of criticism in the last couple of days, and they are likely to cut interest rates rather faster than they might have done previously, and rates there are headed down. This would therefore suggest that what we have is something of a buying opportunity for equities, and similarly an opportunity to take profit on those bonds which have rallied so far. Well, we shall see. Until next week, goodbye.